By the end of this video, you're gonna understand how the stock market really works. You're not gonna have any concerns about how prices change so fastly, and you will also have an understanding of why prices go up or down. Michael EJ here, helping you reach your financial goals and dreams by being the best investor that you can be. If you're new to the channel, what's up? On this channel, we're mainly talking stock market tips and tricks, and always trying to bring a different perspective from anywhere else you would hear, either on YouTube, Wall Street Journal, investor newsletters, all of that. I'm trying to bring you something different. So if you want to be differentiated and learn how to beat the market over time, make sure to like, make sure to subscribe, and let's get started with the video today. So I'm going to walk you through how the stock market really works. Do an example everybody can understand. Retail, more specifically Macy's and Ralph Lauren, which is why I'm wearing the horse here. So this is how things usually work on the stock market. You have a company, you have stock exchange, you got the investor. So we're gonna walk through each part. So first with retail, we all know how it works. Ralph Lauren, they produce the products. They produce their shirts and all of these sorts, you know, trying to sell, either they'll sell directly to the customers, which they do at times with their outlet stores, but forget that for this example. In this example, they're selling it to Macy's at a wholesale price. Give it to Macy's at a wholesale price, and then Macy's turns around, tries to market their product and sell it to you, the consumer, the end person. So that's kind of the setup for a typical retail. The wholesaler, they make the products, send it to a retailer to actually sell it to the end consumer gets it, they're happy. The stock market kind of works in a very similar fashion. You have companies that they want money for shares, they want money for ownership, either to liquidate or to give different investors early in the company, give them a way out, maybe for taking on different products or projects. I mean, companies, they want money for different reasons. So they offer ownership into the company. They sell certain shares, a certain block, a certain amount to the stock exchange, usually at a lower rate, lower discounted rate. And from the initial date of being on the stock exchange itself slightly marks it up, and it tries to sell the shares to investors. Very similar process. There are some key differences though. First, let's look at the wholesaler. Let's look at Ralph Lauren. Let's look at the company. Now, in the stock market, supply of shares doesn't change that much. I mean, from your initial date of filing, the initial shares you give, you're not going to give a lot more shares out later on. If you do, that's usually a sign of trouble. Usually you're not generating enough cash in your business, and you are depending on the stock market to give you more cash. Sometimes it's not that bad. Sometimes asking more money from the stock market is good if you have long-term growth plans that you're trying to go after, lots of different projects that you just can't create enough cash to tackle them all. That's a good sign. That's mainly not the case. More than likely, if it's going to be supply changes from the wholesale perspective for the company, it's usually a reduction in shares. And they usually do that to actually reward shareholders. Because if you reduce the number of shares, there's more profits and more cash and more dividends to go around for the rest of the shareholders. So that's what usually happens on the supplier side. Now the retailer, Macy's, which is the stock exchange. Now, if Macy's really had their way, when inventories, depending on how much inventory they have, they would adjust prices up or down. Usually with Macy's and usually any other pricing out in the real world, prices are usually sticky. They usually are one price, doesn't change that often. I mean, this shirt that I have on from Macy's probably costs, what, $20. It's been $20 for the longest time. Maybe it goes up $5, maybe it comes down $5. Not huge changes, very rarely happens. And if Macy's is going to change the price dramatically, it's the market down, either for a sale or because this shirt isn't selling. So they're going to put it in the clearance and then throw it to the back of the store. Stock exchange, no. You can move prices up and down depending on how much inventory you have. And it happens rapidly. In minutes, seconds, milliseconds. That price is always moving, always trying to match supply and demand. In a lot of ways, this is how the economy should work to some economists. I mean, it's always a matching. If there's high demand for a certain stock, for a certain company, it should rise in price. It should cost more because the stock exchange is running out of inventory. There's more buyers than sellers. Speaking of buyers and sellers, the investor itself, what makes it different than the consumer is that a lot more returns or selling back to the stock exchange. If you actually look at a lot of these retailers, returns and exchanges are a very small part of the company. I mean, in terms of sales, maybe 2 to 5%. Most people, when they buy something, they buy something. They're not going to return it. If they return it, it's because the shirt didn't fit. It was the wrong size, or, it was the wrong color. Maybe they bought it as a gift. Well, let's just say there's a lot of gift returning and we're all growing, because as an investor, you're selling a lot more often, and you're not going to hold on to a shirt forever. You're not going to hold on to those nice pants or that nice jacket forever. You're going to return it. You're going to return it eventually. It's rare that you see somebody actually buy and hold a company for 10, 20, 30 years. That just does not happen today, or to be honest, ever. You usually have to cash out eventually. So that's the main difference between just your typical retail model and the stock exchange. Simple, right? Now, why do certain stocks go up, or why the stock market goes up in general? Well, for a company, it's just more demand than supply over time. There's a lot more buyers, more investors that are looking to buy than to sell over time. That's all pricing is. If the stock exchange is starting to run out of inventory, it starts to increase the price. If there's a lot of sellers out there and look, they're gaining a lot and they don't want to hold it all, they start lowering the price, looking for buyers to come back in at a certain price. That's just all the stock market is. And that's why prices usually go up. More buyers than sellers over a period of time. Now, what leads to having more buyers than sellers? Sentiment. Good vibes with the company, especially on the day-to-day. Now, if you look at pure fundamental long-term investors, they'll tell you that good vibes comes from good company reporting. I mean, they're beating their earnings numbers. They're a great company. They're doing everything right. The financial results are where they need to be. That's one reason. There's a bevy of different reasons why good vibes can happen for a company. That can lead to some stocks shooting way up, some stocks come crashing down, even when the numbers don't support it. One of those reasons is the company may announce share buybacks, rewarding shareholders, or dividends, paying out dividends, increasing dividends. That's a reason for good vibes to happen for a company. Another reason is they just so happen to be in the right industry. I mean, industry investing is very underrated, very not sought after, but it really works if you pick the best companies in the best industries that investors are already interested in. That's a way that stock market can take up, especially in certain industries, certain companies. Other ways include maybe takeover rumors. Maybe a company that is smaller, fine financially, everything looks good, they might get taken over by another company. And usually companies pay a premium to acquire another one. So the stock price might just rise up. If you're a pharmaceutical company, getting any drugs approved by the FDA, if you look at some of those stocks, they just spike up 200, 300, 400% in a day. I mean, it's ridiculous. So you got all these different various reasons why good vibes might happen for a company. And that's really how the stock market works. I mean, it's as simple as that. Just think of the retail model with a few differences. Michael EJ here, coming to you with different ideas, different views, different topics, and just trying to help you reach your financial goals and dreams. And by demystifying the stock market, you can have better comfort into investing, because the way to really reach them is through the stock market. It's a great place to start, and real estate is where a lot of people talk about. It's not really worth it until you get up there, hundreds of thousands, if not millions of dollars. So to get there, before you hop into real estate, hop onto the stock market. I'll see you at the next video. Peace.